that's where we understood our vulnerabilities. And sure, this trade discussion has intensified that talk. But the real problem is supply chains had become too much just in time and had moved so far away from our shores that we really were at a big disadvantage. And so I think from that, so that was in the last administration that these efforts began, and now they're intensifying. So the question is, will this create jobs?
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge. Cathie Wood dives into why Bitcoin and gold can be strong hedges against market volatility, but also why uncertainty still lingers. She breaks it down clearly. Let's watch her explore it all.
We think that what is going to happen in the United States today is what China enjoyed in the last 25 years as it entered the World Trade Organization. In the early days of the World Trade Organization, China didn't have landlines throughout the country, and yet wireless was evolved to a point that they were able to leapfrog the traditional world and go directly to wireless. Same thing with banks. They didn't have a branch banking system throughout the country the way the developed world did. They skipped that and went directly to digital wallets, bank branches in our pockets. So again, that put them at a competitive advantage from a cost point of view. I think that what is going to happen to the United States is, 25 years after our manufacturing has truly been hollowed out, and as we did move manufacturing to much lower cost regions of the world, it is going to come back, but it will not create the jobs that directly that many people expect, because the U.S. now is going to leapfrog China and other places that had enjoyed low-cost labor and did not automate that much. And we are going to bring back manufacturing jobs with automation. Humanoid robots, we think, is a huge breakthrough here. AI, the big enabler. So, but if that manufacturing does come back, it's going to come back to geographies that are going to have to support it. That's where the job creation will be. So yes, indirectly there will be job creation, maybe not directly in the manufacturing plant, although the jobs that are in manufacturing will be very high value add, very productive jobs, and therefore very high paying.
Bitcoin's powerful rally to $95,000 has sparked fresh excitement among investors, and some models now predict even bigger things ahead. One of the most talked about forecasts comes from the Power Law model, which suggests Bitcoin could surge to $200,000 by the end of 2025. This model, championed by analysts like Stina from 21st Capital, uses network growth trends and Metcalfe's law, the idea that a network's value grows with its number of users, to chart Bitcoin's future. According to Sina's Bitcoin quantile model, Bitcoin is currently in a critical transition zone. Once it moves into the acceleration range, price targets of $106,000, $130,000, and even $163,000 could come into play over the next few months. Meanwhile, another well-followed analyst, known as Apps32, believes Bitcoin could reach as high as $200,000 by Q4 2025. His prediction is based on comparing Bitcoin's current movements to its behavior in past 4-year cycles. Historical patterns suggest Bitcoin is following its usual rhythm, setting up for a strong final surge. With gold prices cooling off and Bitcoin recently outperforming, many believe Bitcoin's moment to shine is near. A weakening US dollar, traditionally a bullish signal for Bitcoin, only adds more fuel to the fire.
We've been saying for quite some time that we've been in a rolling recession since the Fed raised rates in 22. If you look at consumer sentiment, especially lower and middle income, consumer sentiment dropped back down to where it was in 0809 for those two cohorts of consumers. And that it has not improved since then. What has happened very recently is high-end consumers. Their sentiment has dropped down to where the low and middle income consumer sentiment has been. So that rolling recession has been in place. Consumers have not been in a good place for a while. Small businesses, if you look at that sentiment index has, as measured by the National Federation of Independent Business, also dropped in 2022 to where it was in 0809 and has not recovered, with the exception of right after the election. There was a burst of hope, and now that's relapsing. If you look at manufacturing, the Purchasing Managers Index, it turned down, went below 50 in late 22 and has stayed there the entire time. So we've been in a recession. Housing was the first to capitulate. If you look at existing home sales, I think they're still down 35% from the peak. And now capital spending is turning down. The two sectors that gave us positive GDP over these last 4 years, high-end consumer and government, and both of those now are succumbing. So we think if you look at the Atlanta Fed's GDP now, I believe it sees for the first quarter real GDP down 2.5%. And we think that there's a bit of paralysis in consumer and business decision making now in the second quarter around tariffs, regulations, tax cuts, what's going to happen, interest rates. And so we think the second quarter will be negative as well. So that's a recession, but we don't think it's the beginning of one. We think it's the end of one that has been in place really, if you look underneath the GDP accounts for the last 3 years, and that we're going to end up, if tariffs are not as bad as we think, fair trade is more the goal. Let's just say fairer trade, as you say, Sonu. And if tax rates come down, interest rates come down, deregulation, we could have in the second half of this year a surprisingly strong economy entering into next year just in time, wouldn't you know, for the midterm elections, which of course would be the goal of this administration.
Bitcoin ETF in the U.S. just pulled off one of their strongest weeks ever, raking in more than $3 billion in inflows. This surge, fueled by Bitcoin's price recovery and renewed excitement from institutional investors, pushed the total assets managed by these ETF to a whopping $109 billion. Leading the pack is BlackRock's iShares Bitcoin Trust, IBIT, which now oversees over $56 billion, about 3% of Bitcoin's entire circulating supply. Some, like Michael Saylor, even believe IBIT could become the world's biggest ETF within the next decade. The biggest days for inflows came on April 22 and 23, when nearly $1 billion poured into Bitcoin ETF each day. Analysts are linking this momentum to Bitcoin's growing independence from traditional assets like gold and stocks, especially as global tensions and tariff wars heat up. Bitcoin's reputation as a safe haven seems stronger than ever. Since slipping below $75,000 earlier this month, Bitcoin has bounced back over 25%, now trading above $94,000. Experts like Mark Blasinski argue that as governments continue printing money in debt balloons, Bitcoin's value will only climb. Looking ahead, some forecasts suggest Bitcoin could skyrocket to between $500,000 and $2.4 million by 2030, as institutional adoption deepens. And do not forget to subscribe to Bitcoin Seller. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you like the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.